you very much, George. Good afternoon, everyone. It's my distinct pleasure to be here presenting to you today. The performance headwind has a question mark at the end of it. I do want to point that out before we start. And les fonds négociés en bourse is just exchange rate funds en français. That's really all that is. Now, you may be asking yourself, why is a guy involved with ETFs talking to us about the merits of market cap weighted investing? I would say that's a pretty good question. Here's my answer to that. The vast majority of the $700 billion or so invested in ETFs globally is in market cap weighted indices. Secondly, pretty much everything I know about indexing I owe to Barclays Global Investors. I was there for 6 years. The world's largest money manager, in excess of $1.5 trillion US dollar terms, and the largest indexer on the planet with over $1 trillion, and who I give credit to for much of the information that I'll share with you. And then finally, because of my time at Barclays, I've been fortunate enough to be able to read and study from some of the great investing minds and their thoughts on indexing. And while this list isn't exhaustive, I'll give you some names. John Bogle at Vanguard, Gus Sauter at CIO at Vanguard, Stephen Schoenfeld used to be at BGI, Joanne Hill at Goldman Sachs, David Blitzer at S&P, David Swenson, who's the CIO at Yale, Burton Malkiel at Princeton. You've probably heard of many of these folks. William Bernstein, who's an author, and some names that probably surprise you. Warren Buffett, Jeremy Siegel, Peter Lynch, and Benjamin Graham. Believe it or not, those last four that I mentioned at one time or another have all said something very positive about indexing and market cap weighted indexing to boot. And in fact, I thought I'd just provide a couple of quotes from Benjamin Graham, since we are at the first annual conference on intelligent investing. It seemed to be a natural tie-in. And in fact, in his first book, The Intelligent Investor, was published in 1949, while indexing and index funds, I should say, hadn't really been invented at that point, he did talk in the book about a defensive portfolio. And by that, he meant that investors that lacked the time, the inclination, or the expertise to do proper security selection would be better off just holding on to the securities passively, and he called that defensive rather than trying to trade too much. So he was really referencing indexing without coming right out and saying it. Then in 1976, he was asked if average managers could outperform the S&P 500, and Benjamin Graham flatly said no. And he went on to say that in effect that would mean that the stock market experts as a whole could beat themselves, a logical contradiction. And that's a quote from Benjamin Graham. So the aforementioned list of sources is not meant by any means, as I said earlier, to be exhaustive. I include them, and I include them more than one name, so as not to be accused of plagiarism, but instead to show you that I've conducted research in putting my presentation together, because I've consulted more than one expert. Now, the title of the presentation is Capitalization-Weighted Indexing, a Performance Headwind, as George mentioned. And I used the second part of the title to just address some of the critics of market cap weighted indexing. So I'm going to take you through a little bit of indexing history, some of the methodologies, talk about some of the index uses, what are indexing actually used for in the marketplace, touch on active and passive strategies, attempting to define one from another, because I think it's quite important. And then, of course, summarize with the cap weighted methodology, which in our view is a natural way to index, and I'll summarize the case for that. Okay, so if we go back a little bit in history, way back, there was nothing, it was blank slate, as you can see on the screen. And then we had, this is the title slide, I'm just going to pass it. Builder slides here. These are all builder. Okay, here we go. Some index history. In 1884, Charles Henry Dow started the first index. Actually, it was 11 stocks. 9 of them were railroads. Railroads are very important at the time. I understand that very few of them actually made anybody any money, but it was very reflective of the market at that time. And then 12 years later, he actually started the forerunner to the Dow Jones Industrial Average in 1896, which was really the first regularly published index. And it was used as a market barometer as well as a market predictor for future performance. People were tracking it. And it was price weighted. And it continues to be price weighted today, which is a standout among indexes. Not too many are price weighted. Then in 1923, Standard Statistics, which was eventually taken over by S&P, created the first capitalization-weighted index. And this was thought of as a better way to measure the market because it really looked at what the average dollar in the market was doing. And then, of course, in 1957, S&P 500 was born, and that makes this index 50 years old. And in fact, of the $5 trillion or so dollars indexed globally, S&P 500 still has the largest share. It represents about 75% of U.S. market capitalization, and it's part of the S&P 1500, which includes the mid-cap 400, the small-cap 600, and if you add it all up, it's just a little under 90% of the U.S. market capitalization. And then finally, and these are just some of the highlights of what's happened in indexing, Russell, which has a Russell 1000, 2000, and 3000, probably best known for the Russell 2000, which is a small cap index. In 1984, it came out with float-adjusted weightings, and most of you are probably familiar with that. But you take the total market cap of a company and you subtract out those control blocks that are tightly held and don't trade, because you can't really invest in that portion that's not tradable, so you subtract that from the market cap. And this has become, in fact, the standard for market cap weighting, that they're also float adjusted today and therefore investable. Okay, so if we take a look at some index uses, there's really three main uses for indexes. The first one is really just to represent the market, a market measure. And this is really the original intention of indexes, again, going back to the Dow Jones Industrial Average. And in fact, when you pick up your morning newspaper or turn on your business news or click on your favorite financial website, you'll likely see one or more of these market indicators. And so you'll know whether yesterday or during the day the market is up, down, or flat. And it can also represent different segments of the market as well. I'll get back to that in a little bit later on. In the 1950s and 60s, academics started to use indices as gauges for active management performance. In 1968, Michael Jensen wrote an article really exposing the inability of most mutual funds to outperform market benchmarks. And he was asking where the alpha was. So that was one of the earlier articles written. And so we started to see the uses of indexes as compared to investment managers' performance. And then finally, 1971 was really the first time it was used. An index fund or an index mandate was created, and it was actually Wells Fargo, which was subsequently bought by Barclays, created the first index mandate for the Samsonite luggage company in their pension plan. And initially, it tracked the NYSE Composite Index, which was an equal weight index. But shortly after that mandate started, they had implementation issues of an equal weight index, and they converted actually to a market cap weighted index in that pension plan at that time. Okay, so speaking of some of the different indexing methodologies, which I've kind of touched upon, we'll go into a little bit more detail here. One way that you can construct an index uses price weights. And again, the Dow Jones Industrial Average in 1896 was a price weight, remains price weighted to this day. And if most of you think back to that time, there weren't very many computers around in 1996. I guess the number would be probably 0. And so Charles Henry Dow, he needed pencil and paper to calculate his index on a daily basis, and price weighting was just the easiest way for him to do that. Unfortunately, price weighting, while it's convenient and easy to do, is somewhat arbitrary in determining. Having said that, the Dow has stood for a long time. It's not a bad barometer of the U.S. market, even though it is price weighted. Market cap weight, which of course is the number of shares times the price per share, so you get the company market cap. Today, it's, as I mentioned earlier, it's used with float adjustment just to make it investable. If you think about it, this really is the market because it represents the total dollars in the market. It's the opportunity set of a market, if you will. Equal weight has been around for a number of years now. It's the same dollar amount in every single position, or same percentage of the portfolio in every single position. Probably the most widely used is an S&P 500 equal weight. The problem here is that there's lots of rebalancing needed, and rebalancing, of course, comes with costs. And it tends to be small cap bias. It gives greater weight to small caps, certainly than a market cap weighted index would. And therefore, with large dollar amounts, there are some liquidity problems, particularly in the smaller end of an equal weight index. So there's some implementation issues with equal weight. And then lastly is the financial measure weight, and here I would include the fundamental, but there have been other fundamental weightings in the past. Probably the first one that was used was a GDP weighting of country allocations across a global index, rather than going by the market cap of each country. It was weighted by the size of their GDP. So that's, in essence, a fundamental measure weight. And of course, the common ones today, some fundamental weightings use a single, but most of them use multiple factors: book value, dividends, it can be the amount of the dividend or the yield of the dividend, sales numbers, or cash flow numbers. So let's take a look at indexing, or the passive side of things just in general, versus active strategies. And I think you'll see my point as we move through this. Indexing really is supposed to represent the market, and I would look at this, and one way to think of it, I think, is an index, is it macro consistent? And by that I simply mean, could all investors hold that portfolio? And certainly with market cap weighting you can do that. Number two is really has to do more with turnover. Transaction costs are real, and when indexes, of course, don't include transaction costs by themselves. But when you go to invest in an index, they certainly are real. They go beyond commissions and administrative costs, and they include bid-ask spread and market impact as well. So taking a methodology from theory to practice can really have dramatically different results, because the costs that in theory aren't there show up when you try and implement. And many strategies that do show a long-term outperformance, in theory, it's wiped out by implementation costs, and turnover is a big factor, of course, in that. Okay. And then finally, a proper index really should be objective. It should be transparent, it should be understandable, and it should be replicable. And then you should be able to very easily follow it and invest in that strategy. Now, when you contrast indexing with anything that's active, and I would include anything that weights portfolio holdings away from the market, what is naturally in the market, and it involves some sort of bet, if you will, versus the market cap weighting. And you can call this active if you want, you can call it beta tilt if you want, enhanced indexing, you call it whatever you like, but it is a bet versus the market on a market cap weighted basis. So there's many different ways of doing this. One is strategic. Most fundamental managers and portfolios, bottom-up managers, have some sort of strategic way of making bets on the market. They have a methodology that they try and identify undervalued securities and overvalued securities, and either don't own the overvalued and own more of the undervalued, or on a relative basis own more of the undervalued. Other way of doing it, of course, is being more thematic, and here you tend to see managers play sectors. A good example would be the resource boom we're kind of in now. If you have a secular view that resources are going to do well, you would overweight that sector in your portfolio and stocks in that sector. You make a bet versus market cap weighting in the market, and of course, if you're right, you overperform. And then finally, and I should say both of those strategies, strategic or thematic, are ongoing real time. You have managers that hands always on the wheel, and every day they may be tinkering with the portfolio and making changes based on their views, based on prices in the marketplace, and it's a dynamic strategy. In the case of rules-based, which is active, I would put fundamental measures in this camp, because you are, again, away from the market cap weighting index. You have some way of making bets. In this case, it's rules-based, and it's just not on a daily basis. It's a less frequent changes. So in each one of these cases, you have a method for saying that securities, I know which securities are overvalued, I know which securities are undervalued, and after all costs, I can take this information and outperform Mr. Market. It's basically what active is all about. And unfortunately, for the average manager, history is not on your side with this methodology. Now, I don't want you to misunderstand me, because market cap weighting indexing in particular does have its flaws. Certainly individual names and sectors can become overweight or underweight. It's always challenging to know, is it overweight now, or is it going to be overweight 2 weeks from now, 2 months from now? But it certainly does happen from time to time. And the other point I would make is that if everyone owned the market, indexing and market cap weighting wouldn't work anymore. In fact, one active investor would be able to find it would be a lot easier for them to find mispricings in the market and make money. It also explains, when you think of the flip side of that, why it's so difficult as an active manager to consistently outperform. Eventually your advantages are arbed away in the marketplace with others stealing your ideas, or by the sheer size of your investable portfolio. But despite these seemingly flaws of market cap weighting, it is still the default. And it reminds me of a little story which apparently is true. I can't attest to that, but I understand it to be true. And it involves Bing Crosby playing golf with some of his buddies, and they stayed afterwards for dinner, and one of the individuals in the foursome was his nephew, who was 14 at the time. And so they stayed for dinner, and they started drinking, and they realized when they were going to go home that the three adults, none of them were in shape to drive home. Now, they lived very close to the golf course in Carmel, so they thought, well, nephew's 14, he can navigate across the country roads home, no harm, let's do it. So they jump in the car with the 14-year-old behind the wheel, and the sheriff stops him. He looks in, he sees the nephew, he looks in the back, he sees Bing Crosby, and the officer says, what's going on here? And Bing Crosby says, officer, he's the best we got. And apparently the sheriff just escorted him home, and that was enough was said. Of course, Bing Crosby was a pretty famous individual. So market cap weighting, maybe it's the best we got. Okay, to summarize market cap weighting then, it really reflects, and I think this is the main point with market cap weighting and the market itself, is it really is the collective forecast of every single market participant. I mean, isn't that really what the market is? The market is a discounting mechanism. Does it not look 6 to 9 months ahead? Is it not a weighing machine, to steal a popular saying? Why do stocks move pre-events? Dividend gets increased, the stock often moves ahead of time. Dividends get cut, the stock often moves ahead of time. Takeovers, stock move ahead of time. The market anticipates. So if it is the collective wisdom of all participants, is it not the best measure of market prices in the long run? Sure, in the short run it can get out of whack. In the long run, is that not the best? Does any one participant or group of participants know more than the collective market does? And I know I'm preaching an efficient market theory here, which there's a lot of holes in that. But over the long run, again, I think it's the best we've got. The other points with the market cap weighting is it does, as I mentioned earlier, it is inclusive. All investors can own this portfolio, and the market would still be in equilibrium. Market cap weighting is also the lowest cost indexing strategy. Extremely low turnover. In fact, in market cap weighting, it rebalances naturally, really. The only time you make changes to a market cap weighted index is when the stock is added or deleted, or when there's a corporate action. So shares are issued, or there's a share buyback. So I would maintain that market cap weighting is the natural weighted index because it offers broad diversification at a very, very low cost. Now, I just want to turn and look at some performance, and I want to set this off with a caveat that performance can be very misleading. This is 10 years to the end of December, and as we all know, performance is very time period sensitive, not only to the magnitude of the time, but when your start date is and when your end date is. So if you're very selective, you can show just about anything outperforming if you really want to. 10 years seems like a reasonable time period, but we could go back further if you like. Just think for a second, if you had a 10-year period ending in 99, what the results would be, whereas if you had a 10-year period ending in 2002, what would the results be? They'd be vastly different. And you don't always have to have a 3-year gap for them to be vastly different. And of course, the problem is with any period that's longer than infinity, is that markets tend to be mean reverting, or in other words, what worked in the past may not in fact work in the future. But with those caveats, we can take a look at this slide here. And you can see that through this period, the darkest line there at the top is the S&P 400 bear of value. Now, through most of that time period, to the December 2005, it was called the S&P 400 bear of value. In 2005, at the end of the year, the index changed the name to Citigroup replaced Barra. So today it would be S&P 400 Citigroup Value Index, just in case you're wondering about the names. But through 9 of these 10 years, the name on the screen was right. So you can see that over that 10-year period, that was the best performer of the indices that we have on the screen. And we've got all of them on there. The first 15 are all market cap weighted indices. The last 3 are not market cap weighted. We've got the S&P 500 equal weight, Dow Jones Industrial, and the fundamental indexing. The fundamental indexing is this solid line, another one of the solid lines on the chart, which is actually just below the S&P mid cap. You can see the S&P 500, the darker blue there. Then these are surprise slides, they're not in your package, but believe me, squish down into the package you have there, they would be hard to discern, but I'm happy to forward these to anyone upon request if you give me your business card. So again, this is a time period, and I'll show you in a few minutes, where of course the first half of it, growth did quite well, and the second half, value did a lot better. But there's been time periods where it's been vastly different. I mean, if we just arbitrarily picked 1937 and 1964, growth absolutely clobbered value during that time period, and it led to the go-go era of the 60s and the nifty 50s of the 70s as everyone embraced growth stocks. So anytime you get a time period where you've got one style or one methodology or one capitalization size outperforming, people seem to jump on the bandwagon. So there's that certainly shows all of the popular indices. To make it look a little bit clearer, there's not as many lines on this chart. Here's the same time period, and again, we keep fundamental indexing in there because it does tend to overweight value in mid and small cap. So we're comparing it with the small, mid, and the value-oriented indices, and you can kind of see where they come out. Okay. I guess the point here is that if you want to make a beta tilt in your portfolio, if you want smaller stocks or mid-sized stocks versus, say, an S&P 500, or if you want value-oriented stocks, you can do that, and you can actually do that, get your performance, and get the benefits of market cap weighting as well. And so there are indices to do that if that is your bias. Okay, and Fama French did a lot of work on this in the past, and of course have been big proponents of this strategy for a very long period of time. Now here's a score sheet on a year-by-year basis, 96 to 2006. And so the same 18 indices are listed there. And again, if you go across the top left, down right across the screen, and then the bottom left across the screen, again, the first 15 are all market cap weighted indices, and the last 3 again are the equal weight, price weight Dow Jones, and the fundamental weight. And so there's 18 of them, so you'll see in each year a number from 1 to 18 to where they finished in performance. And there's some interesting trends if you just look at it this way rather than on a graph. The first I would point out is if you look at the S&P 500 bar of growth, which is the second from the top left, you'll notice how well it did in the late 90s. No surprise to anyone in this room, we know what was going on then. But you had some top finishes, kind of looks like Tiger Woods in major championships, actually. You got a couple number ones there in 97 and 98. And then from 2000 on, how abysmal large cap growth was towards the bottom of the pack in pretty much every year. The second sort of trend here I'd like to point out, again, there's nothing new, but when you stack them up against one another, I think it's kind of interesting to point this out. If you go over to the second from the right at the end on the top, you've got this S&P 600, which is a small cap value benchmark. And again, from 2000 on, look how well that did. So I mean, the market is certainly favored since 2000, since the tech bubble burst, small cap and value. And you can say also that mid cap and obviously value did pretty well through that period as well. And I think the third takeaway from this slide is the last three non-market cap weighted indices in the bottom, you've got 3 indices and you've got 10, or I guess 11, isn't it? You guys actually have 11 years here. So you've got 33 annual events, and only on one occasion did one of those finish first, and that happened to be the price weighted index, the Dow Jones Industrial Average, which I didn't think would be the case, but it certainly is. So again, all the rest are market cap weighted, and again, you can have top performers in any one of those years or through that period using a market cap weighting strategy with or without a small cap, mid cap, value, growth bias, whatever you want. Okay, and still get the benefits of low turnover that market cap weighting has. So just to finish up here, I do want to talk a little bit about active management, because certainly that is the lion's share of the industry that we are in. And I focused on different indexing strategies, but I think I would really be remiss if we didn't address the passive active record just for a moment. Of course, that pretty much involves market cap weighted indexing. Historically in the U.S., approximately 95% of managers have been unable to beat the market cap weighted benchmark. In Canada, that number may be a little bit lower, but it's still greater than 8 out of 10 if you adjust for taxes and survivorship bias. So certainly, again, indexing is a very valid strategy. I think I've shown that market cap weighted indexing can also be a very, very good performer. The second point here is that, again, market cap weighting is the market. It has the same statistical properties of the market: return, risk, skewness, etc. And so if you want a measurement of the market, whether it be for benchmarking purposes or barometer purposes or investment purposes, market cap weighting is certainly the way to go. And I would also say, given that the slides that I showed you with the market performance over 10 or 11, I guess, year time periods, that market cap weighting does not show an intrinsic performance drag. It doesn't mean you have to, if you use it, you're going to underperform. And if anyone here that wishes to read more on this subject, I know that our next presenter will talk to it as well, but if you want to see the other side of that argument, there's an excellent paper by a gentleman by the name of Andre Perot from the Harvard Business School. I'd be happy to show you how to get a hold of that if you want to read a little bit more about this. And then finally, I think time will tell. And again, we talked about performance measurement periods being very selective. And I think that depending what time period you pick, and you can show just about any sort of performance or outperformance. And of course, going forward, we're not sure what's going to work in the past will actually work in the future. I would just like to close by saying that I believe that the market cap weighting methodology for indexing will remain the timeless industry standard. And I'll steal a quote from Winston Churchill, where he said something about democracy that I think applies to market cap weighted indexing. And it will remain the worst system available, except for all others. Thank you very much for your time. And do we have time for questions now, George? Or are we doing them later? Okay. Okay. Thank you very much.